So we're absolutely delighted to have Brian Yacktman and Elliott Savage here with us today. Brian Yacktman is the President and Chief Investment Officer of YCG, which he founded in 2007 in Austin, Texas. YCG is an active management firm that has seen assets grow from $1 million to nearly $1.3 billion as of September 30, 2021, while achieving market-beating performance since inception. Prior to starting YCG, Brian Yacktman was an associate at Yacktman Asset Management, the advisor to the Yacktman funds. He joined them in 2004 from Brigham Young University, where he graduated with a bachelor's in economics and an MBA with an emphasis in finance. Elliott Savage is a partner of YCG since 2012 and is portfolio manager for the YCG Enhanced Fund since the inception of the fund. Prior to joining YCG, Elliott was a senior analyst at Highside Capital Management, a multi-billion-dollar long-short equity hedge fund located in Dallas, Texas. Prior to joining Highside in 2003, Elliott worked as an investment banker at Solomon Smith Barney in New York. He joined Solomon Smith Barney from the University of Virginia, where he graduated with a bachelor's in both economics and cognitive science and a minor in biology. Thank you both for joining us today.
All righty. Well, before we get started, here's the obligatory disclosures page, which you'll all be quizzed at on the end. Now, we plan to fly through this presentation to leave as much time for the Q&A. So please know that as we go through it, you can see it more in detail on our YCG YouTube channel. There's lots of other content there as well, but we're just only going to hit the main bullet points and leave out a bunch. So if you haven't seen it yet, we definitely encourage you to check out the presentation in full. Just type in YouTube YCG investment strategy. And I think we'll put it in the comments below as well. All right. This is just the background that lets you know a little bit about us, that we're based in Austin, Texas, assets under management of 1.4 billion. That was as of December. So now with the recent, big events happening in Russia lately, that's a little different. That's come down a bit. But that's comprised of separately managed accounts and then also a mutual fund. We're employee owned, myself, Elliott Savage, that's here doing the presentation with me, and Will Kruger. And I think a key thing to just point out is that we invest with our clients. A lot of people don't. And so there's been shown studies that there's correlation between performance and eating your own cooking. And so we think it's really a critical element, but we have all of our money invested in this strategy. In these types of businesses and stocks. So either through the fund or through our personal accounts. But we probably define ourselves as high quality value investors. We're seeking high and sustainable returns with long runway of reinvestment and tend to have a concentrated portfolio and very low turnover. This slide shows our performance, and we're pleased that we have market beating returns since our inception. And we're even more pleased to report that we've done that with favorable risk statistics. And so the next question should always be, is this repeatable? And we think so because of our behavioral advantages. We're not banking on having more information or better analytical advantages, though we think we may have some of those. What we really lean more on is the belief that there's some behavioral advantages. And what I'm referring to is like the biases of human behavior. So on average, we found that people tend to be have the desire to get rich quick. And so they tend to overpay for the risky stocks and tend to be less interested in high quality businesses. And so these stocks tend to get orphaned. It's almost like you get paid a premium to be willing to own boring businesses. And so even though they trade at higher multiples than a lot of businesses, they tend to trade a lot cheaper than what they should. Oops, sorry, I didn't mean to move forward. There we go. They tend to trade a lot cheaper than they should because studies have shown they end up providing the same or better returns despite being less risky, which is probably not what you're taught in school. You're taught that you need to take on a heck of a lot more risk to get a better return. But a lot of studies corroborate that that owning high quality has historically shown to outperform. And you would think that since this is known, it would go away. But we think that desire to get rich quick has caused it to be has caused it to be an enduring advantage. So now you're probably, and a reminder that we're skipping through a bunch of slides, so you can still see these later if you'd like on our YouTube channel. So now the next natural question would be, well, what do you mean by high quality? And what we mean when we say that is businesses that have that ability to sustainably compound capital at high rates of return over a very long period of time. And so in our presentation on our site, we go through a bunch of slides describing that essentially competition and innovation have constantly driven down returns on capital. And so I'll flip through these. Okay. And so the real key then becomes enduring pricing power, which we define as a business's ability to keep charging a large premium, even in the face of a virtually identical competitor. And when you think about it, that's extremely rare, because almost any time people can do it better, faster, or cheaper, then you have to drop your prices in order to maintain your own volume. And so we're really trying to find those unique or those special gems that are out there that have that enduring pricing power. And so then, of course, the next natural question is, where can you find that enduring pricing power? Elliott?
Yeah, thanks, Brian. So yeah, and in our view, the two most common traits of a company with enduring pricing power are, number one, that it benefits from network effects, preferably on a global basis, and two, that it operates in an industry or category that is likely to grow at least as fast as GDP. So on the first one, network effects, the reason we think network effects are so important is that the value of the network grows exponentially as the network grows. And so this leads to situations where one network gets a little bit bigger, and then but the value is growing exponentially. And so then it leads to these kind of winner take all outcomes where you get one network that has a huge number of users, and then a lot of others that may have, just a few users. And the one that has a bunch of users creates exponentially more value for its users. And so therefore it can charge a big premium because of that much bigger value that it's giving. So that's what kind of leads in most cases to what we think sort of current pricing power. But then in order to get pricing power, enduring pricing power over time, you got to create more and more value over time so that you can kind of keep raising your prices. And one of the best ways, obviously, with the network effect business to do that is to keep growing it. And in order to keep growing it, it has to be in an industry or a category that's getting more important to society over time. So that's growing as a percentage of people's budgets or as a percentage of GDP. And so we think that sort of those two components are the key ones that you need to look at. And then, of course, once we've identified these global champions with enduring pricing power and then these long-term volume growth opportunities, we also want to make sure that we're protecting our shareholder interests in that business and get to benefit from the value that those businesses are creating. And so the two things that we look for there are that we want, an ownership-minded management team that's really focused on the same thing that we are, which is growing that long-term value of the network. And then we're also looking for a conservative capital structure. And on the ownership-minded management team, you'd think that would be kind of most managements, but unfortunately, the fact of the matter is that the average CEO tenure is roughly 5 years. And so CEOs, even if it's subconscious, a lot of times tend to make decisions that may benefit them over that 5 years, and even at the detriment of the long-term business. And so that's why we really prefer businesses that are family-owned or founder-led, or have a CEO who's a longtime CEO with a lot more stock in the business than sort of options, than stock options. So that again, he or she is very aligned with us as the shareholder and creating long-term value. And then, so then in the second case, we also, we want to protect our equity value. And in order to protect our equity value, we think the business needs to have a conservative capital structure because the future is radically unpredictable. And so we want the businesses to be able to survive, even very extreme economic scenarios. And then, once we've done that, then we want to focus on, obviously not overpaying. And we want to basically do three things. So the first thing is we put numbers to it and we calculate a forward expected return adjusted for risk. And then we compare it to other options available to us. So the most obvious is the risk-free rate. And then, others would be bonds or other equities. And so we just want to make sure that we're getting paid an attractive risk-adjusted return relative to other options available. But then we also think that, again, that there are a lot of sort of psychological biases that work on investors. And so our last two are more psychological. The first is the high quality business mispricing that Brian talked about earlier, where investors tend to they want to get rich quick and they're overconfident about their ability to do so. And so these businesses a lot of times tend to be kind of boring and perpetually underpriced in our view. And then the second psychological thing is what we call the market timing mispricing. And for similar reasons, investors are kind of too short-term oriented. And so they try to dip in and out of stocks when they're experiencing kind of short-term temporary problems. And we think that's too hard to do, and that they end up over discounting those stocks that have great long-term futures, that most people would agree have great long-term futures, but they're experiencing temporary problems. And so we tend to zig when others are zagging, and try to put more capital to work in those situations because of that market timing mispricing. The last thing that we just think is really important about the strategy is the value of low turnover. And because we feel these businesses are almost perpetually underpriced, it enables us not to do a lot of trading. And so as a result, it gives us the ability not just to earn money off of our capital, but also to earn money off the government's money, since we only get taxed on our gains when we sell. And so that's the strategy in a nutshell. Back to you, Brian.
Well, thank you, Elliott. So now we'll just put those all on one slide at once with our summarized conclusions. So the first is we want to invest in these global champions that have enduring pricing power and long-term volume growth opportunities, so they can continually compound capital at high rates of return for long periods of time. But we want to protect that interest by having ownership-minded management teams that have their incentives aligned with ours, and conservative capital structures that can avoid blow-up risk. And then, of course, we want to not overpay by looking for the highest risk-adjusted returns. And we focus on fishing in the waters of high-quality businesses that seem to be perpetually undervalued relative to their dominance. And we avoid trying to time the market in individual stocks. And then once we've done all those things, we just patiently wait. And what I want to be clear about, though, is that this is not a buy and hold strategy. It's really more identify remarkable companies and own them for a long time so that you can participate in that superior performance and just adjust when necessary. So with that, I'm going to take us back to a slide that's representative of our holdings. I think that'll help us so that we have them categorized by some of the key competitive advantages and that we believe enables them to earn these high and sustainable returns. And that way, maybe it can spark some questions if you want to talk about some of the holdings. Let me fly back. And what you'll notice here, the vast majority of the companies that we own are benefiting from some type of network effect. But I want to mention that it's not easy to necessarily just categorize all of them under just one, because many of them are enjoying multiple different types of network effects and have switching costs associated with them, et cetera. So I think this slide, though, can just help provide a jumping off point for questions. And so with that, I'll turn the time to you, Itai.
Yeah, that sounds great. Thank you so much for the presentation. If you could actually just unshare the presentation as well. Excellent. All right. And great. Yeah, so thank you so much for the presentation. And let's dive into some of the questions. So our first question is, why have you been more attracted to a, let's say, more modern Warren Buffett mode style of investing rather than, let's say, a Benjamin Graham deep value kind of value investing?
You want to take that one first?
Yeah, sure. I mean, I think it just really fits with, you know, just speaking for myself, it really fits with my personality. What I've always found interesting is just kind of, you know, all my life, just kind of trying to figure out how the world works and why it works the way it does, and then trying to figure out where it's going. And I think that really dovetails with a strategy where you're just trying to find these businesses that are over a long time period going to create value, and it's just, you know, more fun to study. And then I also think that it gives you a lot better protection in very, very bad downside scenarios, such as the Great Depression, things like that. So it just feels like a much you know, we'll see if we ever have to experience something like that. But it feels like, based on history, that it's a much sort of safer approach that that has kind of always trying to cut off sort of the catastrophic downside in life, and I think that's one of the ways to do it personally.
For me, I think it's just I grew up with it around the dinner table. My dad, he's the most frugal person I know, buying everything on the cheap. He uses coupons everywhere to go get a good deal. We've got all sorts of fun family stories about his frugality. And I think in a large measure, that's what a value buyer is trying to do, is get a good deal. But I'd point out that other than just it being probably nurtured in my home, in college, I read John Train's Money Masters, Robert Hagstrom's Warren Buffett Way. Lawrence Cunningham collected all of Warren Buffett's letters, annual letters for Berkshire, into a book called Essays of Warren Buffett. And I just ate it up. I just loved reading all that stuff and started buying businesses with my own money. And then I loved it even more. So yeah, I think it's just partially in the blood.
Yeah, absolutely. That makes a lot of sense. And can you talk a little bit about when, you know, let's say there's students that one day aspire to start a fund. Any advice on knowing when is the right time to start your own fund and how to raise that initial capital?
So I think it has everything to do with just when you have the capital, because I think you want to expect that raising the capital is going to be 10 times harder than you think. And you obviously can't have a business if you don't have capital to manage. But that to me then goes to show just how critical networking is. So for all of you students at Brown University, I think that probably the most important thing you should be doing, whether you recognize it or not, is just becoming friends and really networking. And it's not doing it just because of the selfish desire for future capital, but it's really that you're doing it because you sincerely want to help find joy in serving people. And as that becomes your nature of just wanting to serve, networking becomes natural, and you develop a lot of friendships, and hopefully along the way somewhere someone will give you a chance.
Yeah, and I would just add on and say that, you know, I totally agree with Brian that you know, there aren't that many opportunities in life where capital is available and willing to, you know, they're willing to give it to you, and so you kind of just have to jump when that happens. But ideally, you want to start, you know, as soon as possible, investing your own money and really try to experience a full cycle because in life there are some things where until you've actually experienced it, you don't know how you're going to feel. And so experiencing a great financial crisis or a tech bubble bust, which was kind of the time that we were coming up, it just gives you a good sense of your emotional makeup, what strategy fits best with that. And so ideally you'd want to wait until sort of after that kind of full cycle of investment.
Yeah, absolutely. I think that makes a lot of sense. And what business globally today do you think has the strongest moat?
I think I'd be looking for global network effects. I think network effects is the strongest moat of all, and particularly if it's global. And then particularly if it's combined with other network effects, especially high switching costs.
Yeah, and I would just echo that and say that I think it's best if you can just have a bunch of moats all interacting. And I would just, Brian and I think the kind of the best moats of all time are like the rating agencies, and the rating agencies, if you just think about it, they have a global protocol network, they have high switching costs, they have a principal agent benefit where you never get fired for hiring if you're an employee of a company, you never get fired for hiring the market leader to rate your bonds. They have a data network effect because all of these companies all around the world over time have given them some non-public information to help them rate their debt, and then they provide the aggregate data to all of the industry participants. And then they've also, over much of their history had a regulatory advantage as well. And so I think it's no surprise that they've been dominant players that have had consistent dominant market share for over 100 years now. And that's even though they made absolutely huge rating mistakes during the financial crisis with MBS and CDOs. Just shows the power of Charlie Munger talks about these Lollapalooza effects. So it just shows the power of all of these things interacting together and creating just an amazing business.
And when Elliott mentioned the network effects, he elaborated on all of them, but just to make sure everyone understands what we're speaking about, when he says protocol network effect, basically that it's become the protocol by which everyone rates bonds. And so it's become essentially a global language. And if we were handed billions of dollars and we said, hey, let's go start our own ratings agency, the problem is that even if we did that and said, we'll rate your bonds for free, that it's not the language that the markets are used to. And so the markets would rebel and cause the cost of debt to go up, making it incredibly difficult to disrupt with a new entrant, which gives them that pricing power. So it's become this powerful global capital market, global language, a protocol network effect.
And I would just make the other point that they have the network effect is so powerful that there's data from Heineken that tried to rate their debt without using Moody's, and some other studies that have been done that show that they may be saving corporates 30 to 50 basis points of cost of capital per year. Yet they only charge 7.5 basis points, and so it's just it's both an enormous benefit because of that network, and then it also just shows the huge untapped pricing power that they have. So they're only taking a small piece of the value that they're giving to the corporations, which enables them to have kind of future pricing power.
And then over the long run, they basically just act as a toll taker on all global debt issuance, because we believe that going into the future, essentially, as more global business is conducted, there will be more debt issued because people will want to continually lower their cost of capital. And as more debt's issued, they'll have these ratings on them. And so it's basically like they're indexed to the growth rate of the rise in global debt issuance. And then they just act as a toll taker on that forevermore. I can't guarantee that that's what will happen, but that's what we believe will happen.
Yeah, and which tends to actually grow significantly faster than global GDP, because as economies scale, first you don't have a lot of debt issuance, then you have debt issuance, but mainly by the banks, and then as the economies get larger and more developed, then you start having more and more capital markets activity. So it's again another one of those examples. You want that dominant network, and then you want that category that sustainably for a very long time can grow in importance and grow faster than GDP.
Yeah, absolutely. That makes a lot of sense. And can you speak a little bit more about how you evaluate management, please?
Yeah, so I think to us, the most important thing, the two most important things are the interests are aligned, as we talked about earlier, where we think principal agent problem of someone not having a lot of ownership in the business and having a shorter time frame is a big issue. And so we want them to either be family or founder or have a big stock holding that's a significant percentage of their net worth. And then secondly, we just want to see that based on their past history, have they shown in the past that they're good at capital allocators and that they're willing to make long-term decisions, even if those long-term decisions result in short-term pain.
And I agree with everything Elliott just said. I'll just say it slightly differently that, when you think about it, the difference between a stock and a bond is that with a bond, there's a coupon that comes every 6 months and you reinvest it. But with a stock, the coupon's essentially being reinvested by the management team. And so how they choose to allocate that capital is so critical to your future return. And so we spend a lot of time just trying to understand, as Elliott pointed out, are their interests aligned? And then secondarily, have they proven in the past, have they done well allocating that cash? We call it guarding the cash, GARDD. They can either G, grow the business, A, make synergistic acquisitions and not overpay. R would be repurchase this more of their stock, more of the same. We love the business, so they're buying more of it. And then the D's are they can pay down debt or pay dividends. But ultimately, it's just how are they doing these things? What's the interplay on the cash flow statement? What kind of returns are we seeing as a result of how they've allocated that cash?
Yeah, absolutely. I think that makes a lot of sense. And overall, compared to in the past, do you believe that it is getting easier for companies to maintain their moats as a result of global scale, or harder for companies to maintain their moats because of the rapid pace of technological change?
I think that's a really great question, and not an easy one. I would say that I think it's kind of split. So for global network effects, I think that they're getting easier to maintain because a network effect is so difficult to disrupt, as we talked about before. Whereas, and in other words, I'm saying it's like a winner take all or a winner take most, almost like unregulated monopolies in a way. Whereas I think if all the other moats are just a moat in isolation, then I think it's a lot more difficult to defend if it's only switching costs or only cost advantages or only intangible assets. I think it's getting more difficult to defend because competition and innovation is getting so fierce. And you can see that we didn't go through it in this presentation, but on our YouTube channel, in that presentation, we go through multiple slides showing how it's after you adjust for inflation, almost every industry is under attack and having deflationary pricing, whereas in real terms, costs are coming down everywhere. And so I think that's evidence that moats are getting more and more difficult to defend and easier to disrupt. But like I say, global network effects, I think, are the exception.
I have nothing to add.
Sounds good. And can you discuss a little bit about how maybe an example of a past investment of yours that was successful in your thesis for it and how you found out about the investment, and the same thing but for a failed investment?
Well, if we're going to be talking about our mistakes, I guess the question is, how much time do you have, Itai? Yes, I mean, we could go on for a long time because obviously we're human and mistakes are a part of being human. But I think, most of our mistakes have been connected to probably trying to go after deep value, declining businesses. And that's why, while we're value investors, we're not just looking for, I shouldn't say just, we're not looking for a business that's in secular decline and looking statistically cheap. And then the other major one is bad value propositions. Elliott, you want to maybe dig in on some of those so I don't talk forever?
Yeah, so I mean, one that we owned a while ago was sort of Ensco, which is this offshore driller. And the more work we did, the more we kind of came up with this framework of kind of how the world works and the deflationary pressure that energy is under over the long term. We just found that it was sort of a mirage that it was cheap, and in a lot of cases these deep value things are mirages because the CEO compensation is correlated with the size of the business. And so instead of the manager just managing it for cash, a lot of times they're hugely incentivized to then take the capital, from this business that has this dominant but declining niche, and then put it into these sort of, you know, much less likely to succeed type ventures, which tends to incinerate capital, and so it tends to be a mirage. Or the businesses we've experienced, they just deteriorate much faster than you think, because once everyone finds out it's sort of declining, everyone kind of leaves and goes to a different company. And then in terms of the value proposition, I would say that we both kind of experienced that with for-profit education companies. And so they had, this was a case where they had just these amazing economic models, but the problem was that, you know, like lots of growth and really high returns on capital, but they were essentially rent seekers, where the value proposition for the customer wasn't very good, and then also the value proposition for the stakeholder, the government, wasn't very good, because these things were defaulting at very, very high rates. And so as a result, you know, eventually if a business isn't sort of at least a net neutral for most stakeholders and a net win for a number of stakeholders, then that kind of gets found out, and the business deteriorates much faster than you would think it would.
And I'd also say that it's also not just sins of commission, but also the sins of omission, right? So like the things that you've missed out on, I think where we've had that mistake is we were probably trying to be too cute on price. So like, for example, I probably should have owned MasterCard, not probably, I mean, it's clear, should have owned it a lot sooner after the Durbin Amendment in 2010. You know, you look back at the returns of the stock since that time, and it's just astronomical. And it's funny to me because back then I actually looked at it and I thought, man, it still looks kind of expensive. And by trying to be too cute on price, missed out on these high double-digit returns for the next, you know, decade plus. And then what happened after it started to rebound is then you start to feel like, oh man, now I've missed it. You know, it used to be trading at these types of multiples, and now it's here, and gosh, I missed it. And then you miss more. And so I think the key is that when you identify a really great business, if it's still priced to allow yourself to deliver a really healthy rate of return, then I think you get involved, you know, and if it gets cheaper, then you buy more. But that's where maybe the amount of degree of your buying is based on maybe the price. But I don't think that you just altogether avoid these really remarkable businesses just because of the price, or else you're going to end up missing out potentially on some really great returns.
I was just going to say, you asked for successful investments, and I would say the one that really sticks out in both of our heads is MSCI, which has really been the most successful investment we've ever had, and it really kind of hits all of the things in the strategy that we're trying to do. So you know, like we said, we want to own great businesses with you know, strong global network effects, and when they're experiencing temporary problems. And so we bought MSCI after they lost Vanguard as a customer, because we thought that the institutional business was safe as a result of this global protocol network, where MSCI is essentially the common language that people use to benchmark and talk about performance. And then we also thought that, you know, it benefited from kind of principal agent considerations, where again, you never get fired for hiring the market leader, MSCI. And then it also benefited from extremely attractive long-term industry tailwinds. And so we've already talked about how capital markets tend to grow faster than GDP. So they benefit from that. They benefit from the indexing trend. And so we saw that, we took a position. And what's interesting is that, you know, it's really, once you find one of these businesses, a lot of times they can surprise you dramatically on the upside. And so with MSCI, what happened after we bought it is that they sold non-core businesses that we hadn't expected them to sell. They bought back a bunch of stock, which we didn't necessarily expect them to do. And then we had the ESG movement emerged as this whole new line of business. And so the business grew much faster and for much longer and at much higher margins than we had underwritten it for. And so I would say that's probably the most successful investment.
Yeah, absolutely. And can you speak a little bit about what your views are on the energy sector today and going forward as well?
So our thoughts on energy, like I think just in general, it's just the fact that the industry is in secular decline. In our presentation, again, that's on YouTube, where we go through the YCG investment strategy, we show a slide where it shows that energy's been in secular decline for, over a century. And it's because over time, what you have is you have reduced demand and increased supply. You have reduced demand because of better recipes to be able to make stuff, so you don't need as much of the commodity, or you have alternatives so that you don't need to use any of the commodity at all. And then you have increased supply because you have better extraction methods to be able to get at that commodity better. And so those two forces, reduced demand, increased supply, has caused, even though the commodities go up in price over time due to inflation, what you've actually seen is after you strip out inflation, the real prices are in decline. And so the industry is shrinking as a percentage of GDP over time. And so ultimately, we look at it and we're like, that crosses off one of our absolute musts, is we want to be invested in an industry that's growing at least as fast as GDP, maintaining its share of GDP, or growing as a percentage of your wallet over time. And there's just, the reason it's not is frankly, there's no pricing power here, because nobody cares if it's Joe's oil or John's oil. It doesn't matter. And so it's just we find it to be an unattractive industry that we just don't participate in.
And I would just say broadly, you can kind of think about the story of civilization as that over time, we are decreasing the costs of all of the sort of survival things of life. So food, energy, things like that are getting smaller as a percentage of the wallet over time because of all of those innovative ways to do all of these things faster, cheaper, and better. And then that leaves more room for other pursuits, such as sort of status competitions. And so you have things growing as a share of GDP over the long term in terms of insurance to protect people's wealth, or in cosmetics, luxury goods, things like that. And so we want to be sort of
or even travel sector, maybe.
Right. Yeah. So we want to have our inputs be the raw materials, and our outputs be these sort of status networks or networks that kind of save you time through just being like a larger and larger and more efficient network, such as a Google or a Microsoft or things like that. And then the other point that I would make is that doesn't mean, though, that it's a straight line. And so there can be obviously, very significant and long periods like the 70s or today, where you have supply shocks, or periods like the early 2000s where you had demand shocks from the BRIC countries, so like Brazil, Russia, India, China, but we just don't think that we have any ability to kind of predict those short to medium term things. We're really focused again on the long term, and so we just leave that to others to try to figure out. And
since Elliott mentioned it, I think I'll just elaborate a little bit that when he was, this isn't about energy, but just in general on the network effects that we're looking for. He mentioned, informational network effects. He brought up Google, which is the most obvious, but basically what we're saying is, if you want to have pricing power, it comes down to having scarcity, right? That's what you learn in economics, is price is going to increase where there's scarcity. And the most scarce good of all is going to be our time. And so naturally, then what you're looking for are network effects that allow us to filter and be time-saving filters. And so really all of them are essentially information filters of some sort, whether it's an efficiency thing or like, maybe you trust a brand. I know that if I go to this brand, it's reliable or high quality or safe, effective, whatever it might be. But we find that information filters are even more powerful when they're connected to status filters or people filters. And so, for example, if it's an information filter like what Tide what detergent do you use in your laundry, such as Tide, that's great, but nobody's really showcasing the laundry detergent that they're using. Whereas maybe cosmetics is actually a social endeavor. And so more pricing power associated with that information filter, as opposed to things that are just purely information when it's connected to social status as well. And luxury goods are the ultimate example of that, because by definition, if it's a luxury good and it's to demonstrate that you command a lot of resources, well, then they have to continually raise the price as there's a rise in global wealth in order for it to continue to act as a good status filter.
Right.
So there's built-in pricing power. So
Go ahead.
No, go ahead.
And the university that you're at is one of the best like Ivy League, higher education is one of the best examples of this sort of people filter that we're talking about, where they've been able to raise their prices far faster than inflation, because the signal that it sends about competence or resources or values is so powerful in a world that's global and where it's very hard and where you have so much choice. It just helps helps people to make choices and align themselves with team members that they think can add value.
Yeah, absolutely. And can you speak a little bit, please, about how you're evaluating? I mean, you have some holdings in big tech. How you're evaluating that from a value investing perspective? I mean, some of those companies, maybe wouldn't necessarily be associated traditionally with value investing. So maybe speak about that framework a bit.
Yeah, sure. So I would just make the point that the big tech companies, if you were to just take them and many people have made this point before, and just cut them in size by to 1/10 of their current size, and look at their returns on capital, their growth rates, and their valuations, it's arguable that they would be actually valued a lot more highly than they are currently. And so I think in this world of so I think part of what makes people worried about the big tech names is just their size, and so how much longer can they continue to grow at these rates? But I think people kind of forget that the markets they're in are so enormous. You're talking about from Microsoft and AWS of Amazon, just like all of sort of cloud infrastructure, and then globally, and then when you're talking about Google, it's all of the global advertising market, and I also think that it's easier than it's ever been before because of the digitalization of the world to grow really rapidly for a long time, even on a big base, because it doesn't really cost anything extra in terms of people hired or things like that, or stores being built out to add a new user or to add a new service and just send it to all existing users. And it also makes the business models much more profitable than any of the sort of large business and higher returns on capital than any of the sort of large businesses from before. So if you think about something like a Microsoft, where it's got a $2 trillion market cap, that seems like it is an enormous amount of money, but the global wealth is at 500 trillion. So for a business that touches almost everyone on the planet, they could one day touch almost everyone on the planet, and do it at an incredibly attractive, returns on capital. Could that, instead of being worth, a fraction of a percent of global GDP, could that be worth 1% of GDP? Very plausibly so. So those would be my thoughts.
So I would just say that, when we're valuing big tech, it's really no different than anything else. We just put it through our framework. I mean, so if you're looking at Google, we're thinking, okay, Google is, it's basically in the advertising business. Advertising is essentially, it's a relative good, where if my competitor's advertising a lot, I have to advertise a lot. And as a result of that, it's allowed advertising space to maintain its share of GDP. And so then the question is, okay, if the industry's maintained its share of GDP over time, the advertising industry, does Google have pricing power within that industry to be able to act as a toll taker on that growth of advertising over time? And, there's a powerful two-sided network effect there. So we'd say, yeah, it appears that it would be. And that's not to say that it can't ever be disrupted, but I just think that if you own a portfolio chock full of global champions that have these dominant global network effects going on, it's hard for a lot of things to go wrong all at once, and things are probably stacked in your favor. He mentioned Microsoft a bit. If you're to talk about Amazon, and Amazon, you look at AWS, there's this ecosystem of software engineers, and it's acting like it's basically like a network effect that has very high switching costs, almost like an app store, if you will, among these software engineers, and tied to all this global IT and the continuing to take share from IT over time. And IT's maintained it's some of it's shrunk, some of it's grown. It depends what part you're talking about. But AWS as a whole should be able to have this massively long runway of reinvestment. And because of its strong, I keep saying that wrong. Because of its strong network effects that are happening there, the protocol network effect, it's become like a language among these engineers. They should be able to maintain pricing power there. And then on the e-commerce side, you have, similar to the Google side, there's advertising built into their e-commerce, which is growing like a weed. But then they're also acting a bit like Costco. So you're looking at the Costco model where they sell everything at cost, super cheap. And then they have their subscription model where then they can raise prices almost imperceptibly year after year because of the tremendous value that they're offering, but be able to raise those prices in excess of inflation over time. And so I guess what I'm trying to say, we could go through all of these, but the point is that we just run it through our framework of, do we think that there are some sort of global network effects going on here that give it pricing power that will endure? And then is there a long runway for reinvestment and growth? And then the other pieces, is it high insider ownership, and is there a conservative capital structure to help us avoid blow-up risk? And then wait, or get it at a decent enough price. And what we found is these things all seem to be trading remarkably at prices that, given their dominance and long runway for growth, as Elliott explained, we just think that they're still attractively priced.
Especially when you consider the risk associated with it, with the businesses in terms of their dominance, their global scale, and their incredibly conservative balance sheets, where all of them have, billions and billions of dollars of net cash.
Yeah, absolutely. And what are some industries that you believe are not in your circle of competence?
So I would highlight biotech for sure, and then also just most early emerging industries. We just don't think that we have the ability to. There will be big winners out of the kind of new emerging industries, but we just don't think that we have the ability to figure out which ones are going to be the ultimate winners. And fortunately, because of the way that we think the world works, we don't think we have to. So we think we can wait until that dominant network has already been, where the economic model has already been demonstrated, and then we think that we can do that again because of these psychological biases that people have, where they want to get rich, they're overconfident about the ability to do so, and so these businesses, again, we think tend to be almost perpetually underpriced. And an example would be something like Coca-Cola. It's unclear going forward. Some of the advantages seem to be eroding, but in the 1920s, 1930s, 1940s, 1950s, 1960s, 1970s, all of those time periods would have been a good time to invest in something that obviously was a great winner with great secular tailwinds and a great economic model.
Yeah, absolutely. That makes a lot of sense. And can you speak a little bit about your process, please, for sourcing ideas and if you use either quantitative or keyword screeners?
So we just read everything under the sun. And I think it's useful to study a new business each day, and then you collectively over time build up this massive library of understanding all the various businesses around the world. But I will also say that sometimes we'll listen to headline news or read headline news, whatever it is, listen or read. And, you know, as you're naturally, when people are running away from something, then that might perk up your ears. And especially it's something when people say, oh yeah, it's a great business long-term, we think it's going to be amazing, but in the short run, there's some issues here. That's when our interest really gets perked up. So I think sourcing ideas is really just being well-read, constantly just digging and looking under rocks everywhere you go, but then also paying attention to where the fires are and see if those fires are happening with businesses that have really great long-term economics. As far as screens, I think Elliott would tell you no, because I don't think he really does any screens. And I would say that almost never, but sometimes I will do screens, and it's more just so I can prioritize or maybe find some businesses that I want to look at. So I might screen for return on invested capital, gross margins, because consistent high gross margins could be an indicator of pricing power. Same thing with operating margins, but particularly gross margins. Return on tangible assets. So what I'm referring to there is your operating income, EBIT. And notice I didn't say EBITDA because I'm wanting to figure out, I'm assuming that depreciation, amortization are going to act as a decent proxy then for what will become a real cash charge to the business, capital charges or acquisition costs, et cetera. So I'm looking at EBIT to understand what is your operating income on the assets that are used to, it's essentially like a return on invested capital, but a little more concentrated. So your tangible assets such as property, plant, and equipment, inventory, plus your net working capital. And so might run screens like that. And then that'll give me an idea of where maybe I want to keep learning about different businesses. But I will point out that I'm not screening on valuations, because to us, it's first you want to screen on the business to understand, like, is this a business that we want to own? Then you look at valuation to make sure, can we get a good rate of return even at this price? So I don't spend any time like searching for low price to book, low price to earnings, low price to free cash flow, enterprise value to EBIT. Might look at some of those multiples occasionally when looking at a business, but not as a screen.
And I would just say that we do have a big spreadsheet of businesses that is just the kind of few hundred businesses globally that we think we understand and where we believe that they do have these high and sustainable returns. And then, like Brian said, we kind of pay attention to the dominant macroeconomic narratives of the time, and then try to find again the businesses that people generally agree have great long-term economics, but where people are trying to dip in and out based on the short-term macroeconomic negatives. And so we found great success with that, such as with, CBRE, the biggest commercial real estate brokerage. There were a lot of fears in 2017 about the death of retail commercial real estate. And there were fears about Brexit and how that would impact their business. There were fears about just if we would go into another global financial crisis, what would happen to CBRE? Because the last time we went into it, it got hurt a lot, but the business had changed dramatically since that time. And so that was a great opportunity. Another great opportunity was, Schwab in 2015, when people feared that, interest rates would never rise again. And then, luxury stocks in 2012 to 2014, when people feared that China's corruption crackdown would sort of destroy demand for them. So there's always something going on where people are worried about how some macroeconomic thing is going to affect things. And it kind of just gets, like right now it's inflation, and it's just like everyone's just talking about inflation. And so that probably means it's time to, as long as you have a very, diversified global portfolio, it's probably time to, trim a little bit of the ones that are kind of benefiting from that narrative and probably time to add a little bit to the ones that are getting particularly hurt by that narrative, because no one knows what the future holds. And if everyone's talking about something, it's probably over discounted in the prices.
And since Elliott mentioned inflation, I just point out that that's one of the great things about being invested in businesses with pricing power is naturally having innate pricing power allows you to maintain your margins in the face of rising input costs. You can raise your prices and maintain your margins. So pricing power, once again, is just such a big key to investing in our view.
And how important do you think either an MBA or a CFA is in investing, and specifically in relation to value investing?
I think it's not so important to become necessarily a good investor and like getting you good investing skills. But I do think that those are both more about sending a signal to land a job. So if you're in a position where, you know, you're in school and because of the network that you've created, you get offered a job and you can get a job without those, then I don't think it really matters, honestly, because in my view, it's more just a signal to be able to show, hey, I'm a hard worker. I can understand things generally. And, you know, it's a signal to say I'm valuable. Now, there are some jobs where perhaps you can't get them without those degrees. And so then it becomes important for that very reason alone. But I'll say that for me personally, I got more value out of reading some of those books that I talked about earlier, you know, and a lot of other, you know, just value investing books in general. Got a lot more out of that, and learning from my father and his tutelage, and learning from my brother when I was at the firm. That was probably what helped me develop my framework the most, and just then real world investing, getting experience in the real world. So.
Yeah, and I would just highlight again, you know, we talked about this already, but time is the most scarce resource and becoming ever more scarce. And so people are looking for, you know, reliable, hard to fake filters that they can then use to make their choices, to make the abundance of choice in front of them more constricted. And so anything that you can do that makes it easier for them to make that decision, or puts you in that pool that they find to be a high value pool, is valuable. So, you know, again, you know, MBA, CFA, and then I would also just say, you know, and doing investment banking in New York, or private equity in New York, you know, these sorts of things. Like my first job that I got after working in investment banking was at a hedge fund, and they only hired really they were only looking at a pool of kind of investment banking analysts in New York. And so you just want to make sure that like you're in the pools that the people you're looking to work for are looking at.
And can you please discuss how you avoid value traps?
Yeah, we don't, but you know, but the thing is that you know, I think one of the most difficult things for a lot of the people who go into value investing, especially if they're sort of high achieving, really ambitious, have succeeded a lot in life, is that investing is not about perfection at all. Like, you're going to make so many mistakes, you're going to fail, and it's just all about like just keeping on and everything. And so it's impossible to avoid value traps completely, but we try to minimize the possibility by doing kind of what we've talked about. So we try to buy, you know, businesses with just kind of simple to understand, dominant global networks, high switching costs, industries growing at least as fast as GDP. Because with a value trap is essentially where the past economics say one thing, and it's trading at a cheap price based on those past economics. And then in the future, the economics turn out to be completely different. And so the best way to protect against that, in our view, is to, again, you know, have those dominant network effects in an industry that's growing, and then to have a conservative balance sheet. So if things do change, you can evolve and you have the resources to marshal behind that change. And we would kind of contrast, you know, eBay and American Express which are businesses that have definitely been outcompeted by Amazon and MasterCard and Visa, but they've still, because they have these big global networks, because they have these really attractive economic models, but because the category they're in has continued to grow, their networks have continued to become more valuable over time. Not at as fast a rate as Amazon and MasterCard and Visa, but they've still become more valuable over time. And so even if you thought that they would stay dominant and you were wrong, you still did fine. Whereas you contrast that with something like an ExxonMobil or a General Electric, and if you were wrong in those cases about it being a good value, because they weren't in areas that had as bright long-term futures, and because they didn't have those dominant network effects, the cost of being wrong was much, much higher. So we're just trying to kind of minimize the cost of being wrong over time.
Yeah, and I'd say that all investing really comes down to what you buy and what you pay for it, right? At the end of the day, you've done a lot of these presentations with other investors, and I think what you'll find is what's in common is everybody talks about probably three main things. It's the business, it's the management team, and it's the price. And when you're buying a stock, you're buying the business and the management team. And so really it comes down to it's what you buy and what you pay for it. And so if price is what you pay and value is what you get, the key is to make sure that you're buying something of enduring value, and then to try to develop frameworks that help make sure that you're landing yourself buying businesses that continue to have enduring value. Now, of course, it's easier said than done. And I mean, we're thinking about this right now with Facebook and our holding there, and wondering, there's still this great several billion network effect that still has great pricing power in this media industry, advertising and social media. But, when the trouble is that managements, they can also end up spending cash flow to try to reinvent the business and get it wrong. And that may or may not be successful. And so I think that's why sometimes these value traps end up even worse off, is you're assessing what you think kind of cash you can get out of it, but you're not realizing that a big chunk of that cash is going to get burned away in the attempt to reinvent. But what this makes me think of is when I think of avoiding value traps, I think usually I found for me that it's avoiding the deep value type stuff. There's actually a slide in this presentation. So over here, I mean, I made a slide talking about the flaws of deep value. And I think that there's just, to me, inherent things. Again, we're value investors, but I think that the idea of just buying something statistically cheap, I don't know that that really works very well anymore. Maybe it did back in the day when people were still getting, they'd order workbooks and or order 10Ks through the mail, and information wasn't as much out there, and you could maybe buy something at one time's earnings. But I think nowadays, most of those opportunities have been taken away. And so here I talk about, so that's the few opportunities bullet. But then I talk about here, like if it's non-cash producing, you're dependent on others to close the valuation gap. I mean, what if the business maybe it just stays about where it is for a decade, right? Well, then your return, if you're buying only hoping on getting a re-rating in the valuation multiple, the longer it takes for that to happen is going to determine whether or not you get a good return. If that re-rating happens in a year, it's going to be phenomenal. If it takes 2 decades, you're not looking at a very great rate of return, particularly if it's non-cash producing, right? Just buying an asset and hoping that it closes. So we don't want to be invested in something that's dependent on someone else re-rating the business. If the stock market closed down, our business will still carry great value and will continue to grow and deliver that cash. If it's a declining business, then you have to make sure you're buying in at a margin of safety that is so large that it's only going to work if the yield to its death is wonderful. And like I mentioned, the yield to the death is that yield has to be including all the cash that's going to get burned on the way by management trying to rescue the business. And then I've just found for me that it's a lot more high mental cost, psychological drain. I mean, you maybe don't have enough confidence to get this holding because of all the problems surrounding it, that you can't take it very large. And then you end up worrying and fretting. So you got a 1% position or smaller, and it's taking up all this mental anguish and time and effort. So I think you get this low return per unit of time and effort. And then once you do successfully find a really awesome deep value play that you make a lot of money on, it becomes tax inefficient, because now you got to sell, pay taxes, and move on and find the next deal. And if there's no deal that's around, you're kind of in trouble hanging out in cash while you wait. And then you have that cash drag. So I just think that there are enough flaws to the deep value part that for us, we found we much prefer that to us, the value investing is found in the margin of safety of value investing is found in the safety of the business that you're choosing to own. And in an economy where a lot of these network effects are becoming winner takes most or winner takes all, I think that if they have that, again, that long runway and pricing power, you have you can continue to participate in that superior performance of these remarkable companies for a long time to come.
And how do you evaluate insurance companies like Progressive?
So with Progressive, what I want to point out is when you look at let me just start by saying this. We've talked a lot about just pricing power being the key, but there is another way to make money, which is by being the lowest cost producer. So it's either you're a price taker or a price maker. If you're a price maker, that's referring to the pricing power. You can set a price and people basically are going to need to accept it because of the value of the network effect that you have going on. And then you can maintain those margins despite people undercutting your price because nobody will move to that network. But the other way is if you're a price taker, you just have to accept the going rate. But the way that you win then is by becoming the lowest cost producer so that you have margins that are that produce high returns on capital. And so then the question becomes, is it enduring that you're going to maintain being the lowest cost producer? So in the case of Progressive selling insurance at the core is just a commodity. In the insurance industry, what we own are the brokers, Aon and Marsh Mac, and then we own Progressive as well. But with Progressive, it's because we believe that they have a sustainable cost advantage as the lowest cost producer. Because competition, basically all the people that they're competing against have a captive agent model where they're not going to want to disrupt their own business by going direct. And then often they're mutual companies, almost more like government run, if you will, in a sense, because the policyholders own their own business. And so it's really less return focused, if you will. And so because of the nature of the industry, we think it allows them to not only maintain their advantage, but continue to grow their share because it's a more cost-effective way to deliver that commodity of insurance. And so you've seen it for decades where Progressive has continually slowly gained share. And I think it's only like maybe 11% share today, but they're still taking share year after year because it's a superior way to get access to that commodity.
Yeah, and then I would just make the point that we love insurance as an industry in terms of its importance to the world over time, because it again, as societies and people get richer, what you find is that they then can afford to spend more and more on insurance, protecting from more and more unlikely outcomes, and so that leads to insurance spending growing as a percentage of global GDP over time, which is a great backdrop for continued growth and profits. And so there are a couple of dominant networks. So the Aons and Marsh Macs, the insurance brokers. Then there's a company called Verisk, which basically has a data network effect. So all the insurance companies supply their particular proprietary data to Verisk, and then Verisk sends out aggregate data to everyone so that everyone can then do a better job of pricing policies and figuring out how to spend capital and things like that. And so those are our two sort of businesses that really fit into our normal framework. And then we think Progressive and then, Geico, which Berkshire owns, are sort of the real two exceptions that prove the rule in insurance, because the rest of insurance is pretty much just brutal and commodity-like.
Yeah, absolutely. I think that makes a lot of sense. And what are some permanent changes in the economy that you see resulting from the pandemic?
So for me, I think that mainly it's just accelerated the changes that are already happening. Such as more e-commerce, or it's a more cashless society. There may be, some changes that could be permanent. Like one that comes to mind is just the focus on not just being pure efficiency, but more resiliency over efficiency, in the way that, supply chains is an example of just how making sure that your supply chain is more resilient. I think hybrid work, it's not going to be for a long time it became work from home, and now we're kind of in this hybrid environment. And I think we're social creatures, and there's synergies with in-person teamwork and just the body language that happens by being in person. So I think that there definitely will be a lot of return to the workplace, but I think that what maybe is here to stay is more hybrid work. And then another one that comes to mind is business international travel, or maybe just corporate travel in general. It seems like perhaps that's a little bit more lasting, or it could just be a lot slower to recover. Because the one thing that makes me wonder, would it still maybe recover and come back, is, what if the narrative becomes, your client saying, what, am I not important enough for you to show up in my office in person? Am I not important enough for you to take that international flight? And if that's kind of the way it is, then I think you're just going to see a slow return. Eventually it goes back to where we were. But in as much as people are still accepting of, we can be very productive over Zoom, and that's effective, then I think that may actually be a permanent reset in business international travel, or maybe even domestic corporate travel.
But I would just say that we would both definitely caution everyone and say, like, we do not spend a lot of time trying to figure this stuff out. The most important thing to understand about the world, in our opinion, is it's like radically unpredictable. I mean, you think about like CBRE, for example. A few years ago, people were saying, retail is dead. And now all the e-commerce players are saying, oh, we have to be omni-channel. And so we think it's much better to make bets on sort of more base fundamental aspects of human nature. And one quote that we really like is sort of Jeff Bezos, where I'm paraphrasing. He says that who knows what kind of technologies will deliver all of these things, and they'll need to use, but you can be pretty sure over time that people will prefer cheaper prices, more selection, faster shipping. And we would just add to that we think it's very likely that people will continue to jockey for status. And so sort of status symbols will continue to be more valuable over time. That global wealth will continue to rise as a result of innovation and increased knowledge. That there will be violent, unpredictable, and positive feedback loops, creating big up and big down economic cycles. So you got to be conservatively capitalized so you can get through those. And then the principal agent problems where you don't get fired for hiring the market leader. And so we really try to focus much more on those than kind of like these trends that we don't think anybody can really predict.
Yeah, and can you please discuss your framework for when you sell an investment?
Yeah. So I would say that the main thing that causes us to sell an investment is that we were wrong about the business, and so I think, or that we found better businesses in the same category that we think more align with sort of the dominant networks and things like that. And so just some that come to mind are Richemont, which is a luxury goods company we sold, and instead own Hermes, LVMH, and Ferrari. And then another example would be, we used to own all three banks, Wells Fargo, Bank of America, and JP Morgan. now we own just JP Morgan and HDFC Bank in India. So I would say that's like the main reason, is just that we find out that we were just wrong about the business quality. And then the second reason, another common reason is just that what we talked about earlier with sort of the market timing mispricing, and just if you have a situation where businesses are getting hit, where some businesses are really benefiting from a macroeconomic narrative, some businesses are really getting hit, but we're still confident in all of the businesses' long-term future, we may do some trimming of the ones that are benefiting and adding a little bit to the ones that are getting hit. Yeah, and then Brian, do you have any additional comments?
Well, I'd just say that if I were to make it super short, that essentially what you said is either we're wrong, right? The thesis has changed, the business isn't as high of quality as we thought, or the market is wrong, that it mispriced a security in a way that allowed us to get a better opportunity. And so I really think it comes down to one of those two main things: we're wrong or the market was wrong. But I would point out too that we're not looking at price targets. It's not like, here's the price target and then we want to sell. We're calculating a forward rate of return and saying, okay, based on all the available investments out there today, where do we want to align our capital given these forward rates of return? So it's almost like a bond table, and then looking at the quality. So, but I will say that it's really hard because you don't want to pay taxes. I mean, as much as possible, you want to benefit from that low turnover, because as soon as you pay tax, that money is gone forever. Whereas if you were able to hold on to that money and not pay the tax, you could continue to compound on Uncle Sam's capital, essentially. So if you're going to sell, you got to make sure that it really is making sense. And so we'll look at these crossover analysis where we say, does it make sense to sell the security here, pay taxes, and now reinvest a smaller amount of capital because we believe the forward-looking return on this business is that much better? And so I guess what I'm trying to say is you want to try to make as little changes as possible. And that's why it's so important, I think, to do your homework well, to make sure that you're really trying to buy these wonderful businesses. Because if you get it right, man, you can compound on Uncle Sam's money for decades to come.
Yeah, absolutely. And can you discuss, please, your approach to portfolio diversification, position sizing, and portfolio turnover?
I'd just say that it's much more an art. That we're just going to try to concentrate in the best businesses. Like I said before, look for the best businesses out there with these global network effects and pricing power. Once you find them, then we might look at the correlation of the cash flows to make sure that you're diversified enough across all these different dimensions, like macroeconomic activity or the product category, geography, currencies, etc. But we'll create these baskets and sleeves of, so that we don't have too much of a correlated asset in the same industry. And typically those sleeves tend to be, 5 to 8% kind of a sleeve. And then we just try to diversify as much as possible inside the best. So it's on the one hand, you read a lot about, you want to be concentrated so your performance can be, so you can have great performance. But at the same time, if you find two businesses that are equal, almost identical in every way, then why not diversify into two of them if they seem to be very similar pricing power, similar industry? You may as well avoid the idiosyncratic risk. So, but again, I just think it's much more an art.
So the examples, obvious examples that come to mind on that last point that Brian's making are, MasterCard and Visa owning both instead of just one, or Aon and Marsh Mac owning both instead of just one.
Yeah, absolutely. I think that makes a lot of sense. And for a concluding question, what are the most influential events of your investing careers?
Yeah, so I would say that it's definitely, we both came of age, and we're in college during the kind of tech bubble and burst, and we're trading stocks during that time period, and then professionally, during the great financial crisis, and then also, COVID. And so I would say that, and then also we've studied the Great Depression a ton, with the Great Depression, a diary, this guy, Benjamin Roth, who kind of chronicles his time and kind of what he thought in the moment and what people were thinking in the moment. And I think it just really reinforced to us the radical unpredictability of the future, and also just the huge value that even if quality stocks don't outperform, even if they become sort of more popular than the past, and they don't outperform or even underperform a little bit, the protection they give you in those couple times in a century, just absolutely catastrophic events, is so valuable that it really reinforced for me the value of just having that quality approach. You look at the performance of AT&T or Coca-Cola during the Great Depression versus many of the leveraged companies, more industrial companies. They went down less, came back faster. It's just so much easier to deal with that and live a life of where you're not going back too much, and where you're kind of constantly just making some progress, which I think is a way to, I think one of the ways to kind of help yourself with having a happy life is just to kind of constantly try to make slow and steady progress and not feel like you have to do it all at the beginning, because in order to do it all at the beginning, you're probably taking a big risk. But if it doesn't work out, then it's 2.5 times more painful to lose than it is to gain, and so we just try to factor that in to our approach, both for ourselves and especially for our clients, who we want to protect, who we want to grow their wealth over time in as risk advantaged way as we can.
Yeah, I think Elliott nailed it. That the same for me, that .com era and then the Great Recession is kind of the big career events. But I think more so though, when you speak of being influential, to me it's that little by little, day by day, by small and simple things, great things come to pass. And so when I think of like major moments of influence, it's all those, the dinner conversations with my dad, or working at my father's firm, learning from him and my brother. And then really for me, probably the biggest influence has been getting to know Elliott, who's just extremely well read and brilliant. And so you have these conversations and you continue drop by drop to just learn. And then I think that is what creates those big influences, is the small and simple things.
Yeah, and I would agree that just like having great partners like Brian and Will, our other partner Kruger, to just learn with and grow with, and to where everyone's sort of open-minded, just trying to get better every single day. Yeah, that's where, again, it's all about compounding and just just consistent small improvements over, multiplied by a long time period, lead to hugely positive outcomes. So you don't have to get from A to Z in the first year. It's just, in our view, it's much better to just have sort of slow, steady, consistent improvements, because you're almost certain to have major positive outcomes over the long term.
Yeah, absolutely. Thank you so much. This is a phenomenal session, and thank you for taking the time out of your busy schedules to speak with us today.
Well, thank you, Itai, and we've enjoyed answering the questions, and wish all of you best of luck in the future.